Are you ready to make your money work for you but unsure whether to dive in all at once or dip your toes in gradually? Welcome back to our channel, where we help you navigate the world of investing. In today's video, we'll be exploring dollar cost averaging versus lump sum investing. And by the end, you'll know which strategy is right for you. But first, do me a favor and like, share, subscribe, and hit the notification bell to stay updated on all future videos. Let's dive in. Imagine you've just inherited a large sum of money, or maybe you've been saving up for years. The question now is, do you invest all of it at once, or do you spread it out over time? Stick around to find out which strategy could maximize your returns and minimize your risks. First up, let's talk about dollar cost averaging, or DCA. Picture this. You're a farmer planting seeds in your field, spreading them evenly across the land, ensuring growth in various conditions. That's what DCA is all about. You invest a fixed amount of money at regular intervals, regardless of market conditions. This way, you're buying more shares when prices are low and fewer when they're high, effectively averaging out the cost of your investments. So, why do investors choose DCA? Well, it's like setting your investments on autopilot. You only need time the market or stress over when to buy. Plus, it's an excellent option for those on a budget, as you can invest smaller amounts consistently over time. This disciplined approach can help you avoid emotional decisions, like panic selling during market downturns. And now that we've covered the basics of DCA, don't forget to check out the description box below for some valuable resources. Now let's switch gears and talk about lump sum investing, or LSI. Imagine you're a thrill seeker, ready to jump off a cliff into the crystal clear waters below. That's LSI in a nutshell. Taking the plunge by investing all your available funds at once. The idea is that, historically, markets tend to rise over time, so the sooner you get in, the more time your money has to grow. But why would someone choose LSI over DCA? It's simple. When the market's on an upward trajectory, investing a large sum all at once could result in higher returns than gradually investing. However, it's important to remember that LSI comes with its fair share of risks. What if you invest right before a market crash? Timing is crucial, and let's face it, not everyone has a crystal ball. By now, you might be wondering which strategy suits you best, the slow and steady DCA or the daring LSI? To answer that, let's consider a few key factors. First, ask yourself, how much risk am I willing to take? If you're risk-averse or a beginner investor, DTA might be the safer bet. On the other hand, if you've got nerves of steel and a solid understanding of market trends, LSI could potentially yield higher returns. Next, consider your financial situation. Do you have a lump sum ready to invest, or are you working with a limited budget? Remember, DCA allows you to invest smaller amounts regularly, while LSI requires a significant sum up front. Finally, evaluate your investment goals and time horizon. If you're investing for the long term, LSI might make more sense, as historically, markets tend to rise over time. However, if you're seeking short-term gains or worried about market volatility, DCA could be the better choice. Now let's discuss an interesting twist, combining dollar cost averaging and lump sum investing. That's right, you don't have to pick just one strategy. You can actually use both to your advantage, creating a balanced approach tailored to your unique financial goals. Consider this scenario. You have a sizable lump sum to invest, but you're worried about market volatility. In this case, you could invest a portion of your funds using LSI and then use DCA to invest the remaining amount over time. This hybrid strategy offers the potential for immediate returns with LSI, while mitigating the risks through DTA. Before we move on, let's dive into some tips for successful dollar cost averaging. Keep these points in mind when implementing this strategy. Be consistent by sticking to a regular investment schedule, regardless of market conditions. This helps you avoid emotional decisions and ensures you're buying at different price points. Reinvest dividends to purchase additional shares, which can boost your returns and help your investments grow even faster. Stay diversified by not putting all your eggs in one basket. Spread your investments across different assets and sectors to reduce risk and maximize potential gains. Now, let's explore some tips for successful lump sum investing. Do your research by studying market trends and economic indicators to make well-informed decisions. Remember, timing is crucial in LSI, so make sure you're investing with confidence. Diversify your portfolio by allocating your funds across various asset classes and sectors. Keep an emergency fund by not investing your entire savings. It's essential to maintain a separate emergency fund for unexpected expenses or market downturns. We've talked about dollar cost averaging and lump sum investing, but let's not forget the importance of risk management in investing. Regardless of which strategy you choose, managing risk is crucial for long-term success. Here are some tips to help you protect your investments. Set clear investment goals by defining your objectives and time horizon. This will help you create an investment plan that aligns with your risk tolerance and financial needs. Monitor your investments by regularly reviewing and adjusting your portfolio as needed. This can help you stay on track and ensure your investments continue to support your goals. Consider working with a financial advisor if you're unsure about which strategy to choose or need help managing risk. They can provide expert advice tailored to your unique situation. Lastly, let's discuss market timing, the idea that you can predict market movements and invest accordingly. While it may sound enticing, market timing is notoriously difficult, even for seasoned professionals. Studies have shown that consistently timing the market is nearly impossible, and attempting to do so can often result in missed opportunities and reduced returns. Rather than trying to time the market, focus on creating a long-term investment plan that aligns with your financial goals and risk tolerance. Whether you choose DCA, LSI, or a combination of both, sticking to your plan and staying disciplined is the key to success. So there you have it, an in-depth exploration of dollar cost averaging and lump sum investing, along with valuable tips and insights to help you make the right choice for your financial future. As you can see, there's no one-size-fits-all answer. Your ideal strategy will depend on your risk tolerance, financial situation, and investment goals. But with the information we provided today, you're now better equipped to make an informed decision. Before we wrap up, we have a question for you. If you had $10,000 to invest today, which strategy would you choose and why? Have any of our tips and insights swayed your decision? We'd love to hear your thoughts in the comments below. If you found this video helpful, don't forget to share it with your fellow investors. Thank you for watching.